Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 20-some minutes here on Options Guide TV. So we obviously had some headlines over the weekend that are greatly affecting the markets. We've seen the VIX spike up to the 19% level. It's came off a little bit just recently based off, I guess, some headlines from the president of Mexico that is mentioning will be sending troops to the border as part of the tariff negotiations. And those tariffs have been delayed about 30 days. So the market is trying to bounce back. And in this instance, we also see the IWM is trading at 225. That's down 142 on the day. Do still have a position on in the IWM. I actually sold my calls out on the upside, but the position that we had on the show was a little bit different. So at this instance, IWM would have been a good trade to get out of on the open. Don't know if I want to, right now it's not down enough to start with. Overnight, it was down about $5 or 2.5%. And right now IWM is down 0.5%, down 136 at 225.14. All right. So this week we do have a lot of mega cap tech stocks that are going to be announcing earnings. We had obviously Apple last week. This week we're going to have Amazon. We're going to have Google that will be announcing. So it will be a very volatile week once again as far as big companies announcing earnings. The stocks that are actually getting beaten up the most right now are the motor companies, Ford, GM, even Tesla. All of those stocks are actually down quite a bit on the day, worried about the tariffs that are happening in Canada. Ford is really taking it on the chin quite a bit recently, still battling to try to stay above the 10 handle as far as Ford is concerned. So today, what I'm going to do is first of all, start by looking at Amazon. We put a diagonal spread on Amazon a couple weeks back, and in that diagonal spread, we sold a shorter term option contract and then bought a longer dated option contract that expires after the earnings report. They are going to announce on Thursday, and at this point in time, we are up fairly decent on the position in that we put this trade on when we rolled into the Amazon trade. The total cost of the trade was around $2, considering that we closed a shorter term option contract when the market ran up, took some profit on that, or I'm sorry, when the market was down a little bit. Then we took some profit on that and rolled it to the 255 strike call with the same expiration date that contains the earnings report this Thursday. So February 7th is the expiration date. It's 4 days away. The option contracts that we are trading is the February 7th expiration. We are now long the 245 strike call, and at the same time short the 255 strike call. We could sell it and get out and make about 60 cents at this point in time. Market is down, just like everything in general is down. There's still some stocks that aren't considered I don't know, affected by the tariffs that are holding their own. Healthcare is one of the areas where the stocks are actually doing fairly good, or one of the sectors that the stocks are doing fairly good today. I don't necessarily know exactly why, but I guess it's just the fact that it is not related to tariffs and it's not considered an industry that would be affected by the tariffs mandates between China and Canada and Mexico. Okay, so with all that said, 245 selling the 255s. I think we'll stay the course in this. Market's down a little bit today. Could see a little bit of a pop coming back. But I also want to do a speculative trade, a one-day trade in Amazon. We'll probably put that together on Wednesday, considering that they announce earnings on Thursday after the close. So we'll look at some type of butterfly that will go along with this position. And because of that, I might close this position on Wednesday, see where it ends up at. If we got a cost basis of about $2 on this trade. if we can turn that into, if we can make a buck on this trade or a $1.50, somewhere in that range, I don't see any reason to not close it out, only because I do want to actually talk about a speculative butterfly in Amazon going into that earnings report. As I've always mentioned, I love the fact that Amazon usually announces earnings on Thursday, which means that you have one day for the Friday option contracts to live. You have a fairly pricey stock. You obviously have a pumped up implied volatility, and all of that has to go away in one day, which always makes it fun to look at option trades on that Friday. Okay, so we looked at PayPal, which with the way the markets are, that didn't really help to talk about it on Friday. We did mention that they are announcing on Tuesday. So the PayPal trade that we put on Friday, I would adjust. I highly doubt that anybody actually considered it on Friday, considering that we had Monday to try to figure it out before the Tuesday earnings report. And all we did was straddle the market, and we did it 6 points wide. So I'll go and look at that. But PayPal right now is down 54 cents on the day. So this would, if you did not do that and you are interested in doing the PayPal trade, there's a little bit, some upside momentum. I don't mind doing a 50-50 trade in PayPal, basically 50% chance of making money versus losing money. And we do that by straddling the market. So market has bounced back. Actually, it was down a little bit more than this today. So maybe our spread is doing all right. So here's the one that we looked at. PayPal was at $90. We came in and bought the 87. We bought this one. And we sold the 93, and this is the one that we sold. So $2.54. Yeah, we're down about 45 cents on it. We did it for almost $3, so we'll call it 45 cents on the trade. Now, if I were to adjust it to today's prices, I would look to do it a little bit closer to the close, because once again, it's a purely speculative trade based off of what may happen after the earnings report, and we would just slide it down a little bit. So let's get rid of these legs. We're going to straddle stocks right at 88, makes it simple. So this should be trading for $3, very close. So we're going to look at buying the 3 points down, which is 85, selling 3 points up, which is 92, $3.38. 85. No, that's because I'm off on this one. All right. 91. And sell that. Yeah, there we go. 302. And the reason why we know that it's going to be about 302, because equidistance in and out of the money on option contracts, especially with shorter term expirations, right, is usually the same amount of time premium. And here's what I mean by that, in that if we're buying the 85 strike call, we're paying $5 on the ask price is $5.60, but paying attention to the time value, or otherwise known as the intrinsic value, it's $2.30. It's moving, obviously, $2.30. Well, this option contract is $2.50 at the midpoint. That means that you are selling a little bit more time premium that you're buying, but they're fairly equal. And if that is the case, then based off of where the underlying stock is at, and it's not hanging out right at 88, but based off of where that is at, you can usually straddle the market and get something that's going to be a 50-50 risk reward scenario. So you pay $3 for it, and we're going to call it $3. Let's make it simple. And you have the potential to make 6. So 6 minus 3 means that you have the potential to pay 3 to make 6, or pay 3 to make 3, right? 6 minus 3 is 3. So 50-50 bet on the trade. They're announcing earnings in the morning. Getting bullish. If you want to do bearish, you could. I feel a little bit more comfortable with PayPal kind of making their comeback a little bit. They got beaten up so bad. And I mentioned on the show that I took my comeuppance on it. I was long the stock, but I got out at a stop price well before that. And let's go back in time. Let's go 1,500 days. And you see almost a little cup and handle that's trying to work its way around. So the stock dropped precipitously. And I guess you talk about the Venmo, talk about all the people that have came into the space where that allows you to move money simply. PayPal was one of the first, but now they're trying to make a comeback. It looks like we had a little bit of a bottoming pattern, and see if we can break out to the upside. So right here is a very interesting point, right? Because you're talking, there's a lot of noise right in this space. This was the previous high where we dropped down, came back to that, and that's currently where we're trading. So if we zoom out a little bit on this, and we zoom in this corner, you see that if we can make that breakout through the earnings, we do got the potential to go higher on this one. So I don't mind the PayPal. I do this around the earnings and after the earnings report. If you wanted to, if we do get good news, the market is a little choppy right now. Not a lot of paying attention to exactly who's announcing earnings. That's not really what's making the headlines. It's all about tariffs at this point in time and executive orders. So with that said, if we do have that earnings report and it is strong and we do get a little bit of a movement to the upside, the chart looks kind of interesting in PayPal. That simple. All right. So if you have any questions about these two trades, if you put it on Friday, well, I guess I would just ride it through the earnings. The expected move in PayPal, let's go back and look at that. Pull this up. The expected move on PayPal is, if we look off of 88, it's up a little bit. Let's actually put it in. Be buying this one and buying this one, $7.50. So if we looked at the Friday trade, the position's down about 45 cents on that trade. The expected move is about $7. So what we're saying is that if you ride it into earnings, which is tomorrow, you still have the potential for the movement to reach your strike on the upside, right? So at 88 plus 7, that would be 95, and it's $7.50. So our upside strike is 93. So I wouldn't mess with the trade if I put it on Friday, because it's all going to still be about the earnings report, and odds are that it's going to move plus or minus 7 points based off of what is perceived from the earnings. It doesn't necessarily mean that it will, but that's what the marketplace is anticipating based off of that news, riding into the end of the week using the February 7th option contracts. All right. Google, we got Google to look at too. And Google is going to announce, let me pull it up here. On Tuesday, is that when we have Google, or do we have Google this week on? Google is Tuesday after the close, along with AMD, Advanced Micro Devices, and Google. But we're going to look at Google on Tuesday, February 4th. Okay, so Google right now is down 120 on the day, trading at 202.83. I don't mind looking at Google and doing a short put spread in the short term, but I'm going to make the risk reward fairly decent, right? So we're going to sell something at the money. You could put this on Tuesday. You could wait till the earnings, but I want to bring in a decent amount of credit and sell our put spread on Google. So in this instance, we're going to sell the 197.50 strike, and I'm going to click on that. We're going to be bullish, and we're bringing in $4 on that trade. Now, if you don't want a ton of risk, I would go down to the 192.50 and make this only a 5-point wide trade, and we would buy that. And in this instance, we're bringing in $1.66 to try to make with a risk of $5 overall on the trade. And let's send this to the what if calculator. And then I'm also going to toss this one into the fold. Let's pull this on down. Our max risk on the trade is $355.50 based off of that midpoint price. And I don't mind going in and going a little bit wider and bringing in a decent, a real credit on this. So let's get rid of this one. And here's the second one that I would look at doing. Let's go down to the 187.50 right here. And we'll buy this one. All right. And here we're making $2.71, or we're bringing in $2.71. We're not making it until that earnings report. And we'll send that to the what if calculator. You got a little bit more risk, but a little bit higher reward. So the total risk, if you look at total risk and you decide if this is risky or not, is you look at the total risk, which is 5 points wide minus the net credit brought in. That's $3.35. $335.50 is the total risk per 1-by-1 spread that you would do. Or if you look at this vertical, you have $729 of total risk based off of the $2.71 net credit. We'll call it $2.70 net credit. So fairly close to those amounts. Those numbers are obviously fluctuating as we're moving. But these would, I don't mind getting bullish on Google heading into their earnings. So I'm looking at doing a short put vertical spread. I'm not doing anything fancy, not trying to get long the marketplace and by doing a long call spread. So we'll do a short put spread, which is neutral to bullish on Google heading into their earnings on Tuesday. All right. So let's go and check this out. So the three positions that we have explored today, we have, one second here. We look at Amazon and the position we already have on because we actually legged into the trade. We did a diagonal trade, had the shorter term option contract be profitable. Let's put it that way. Rolled that into a long call spread, which is now profitable. And we have to decide going into earnings if we want to ride it through earnings or do we want to close out the trade. I'm going to lean towards closing it out because I think I want to put a different trade on Amazon on Wednesday. So we'll look at that on Wednesday. And then we have PayPal tomorrow. So we adjusted the strikes. If you put it on Friday, well, we would still ride it through the earnings. We still have the expected move is well within the range of reaching our top strike on our long call spread. And then lastly, let's do a short put spread in Google. And I'm doing it a lot because we don't do a lot of short put spreads or vertical spreads around earnings. And if I'm going to set it up, I want to set it up where I'm bringing in a decent amount of premium, but I do have more risk than the reward. And that's almost always going to be the case on credit spreads where you're selling them a little bit out of the money in that scenario. So we'll look at that. They're going to be announcing Tuesday after the close. So on Wednesday, we're going to have a lot to talk about. And if we don't have any questions at this point in time, and I do not see any, those are the three trades that we have going on. And we'll have a lot of fun looking at them. Not to mention the IWM trade. There was an opportunity this morning to potentially close out the long put side of the long straddle. But that opportunity didn't hang around very long. So let's hope that there is another opportunity to do so here in the short term. If not, we're going to have to get out of the position. We've got about 18 days remaining until that expiration date on those option contracts. So we'll let it ride for another week and see where it's at. Thanks for tuning in. And you can follow me on Twitter. My handle is @BrianOverby. And we'll be here this Wednesday for the next edition of Options Guide TV inside the Tradier Hub, hub.tradier.com. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.